Hello, this is Jordan. This video is being recorded on the late evening of Tuesday, December 13th, 2022. Thanks so much for joining me today. In this video, I'm going to discuss the crash risk for the stock market in 2023. And, more so than crash, I think a better term is accelerated decline. Because when you think about certain bear markets, there is part of those bear markets, there is a crash type decline. In other bears, you can say it's an accelerated decline. So I like to think of it as an accelerated decline. And looking at my study of mega bear markets, and so we're looking at, in my opinion, there's 6 mega bear markets. And so every secular bear market, we're looking at 29 to 42, 68 to 82, 2000 to 2011. Those 3 secular bears, they have 2 nasty cyclical bears within them. And then at the very end, there tends to be like a small third bear, which is more of a mild bear. So that's how we get the 6 mega bears. And in here I'm showing 5 because 5 of the 6 are they've followed a very similar pattern. Now the one that's not here is the 1937 to 38 or 37 to 42 one. And the issue with that is even though it followed a similar pattern over the first 6 or 9 months, that bear market just happened so quickly. Its accelerated decline happened so quickly that when we're at this point in the bear, we're roughly a year into it. It's no longer a viable comparison to all these other bears. And so, what we see here, and this is, I believe we put this up, I want to say a month ago or 2 months ago, and you can see that we are right at the point right now, whether it's right now or, yes, I mean, it is right now. We could say right now or in the next month or two, based on history, now, December or January or February, this winter window, this is a window where the market is ripe for a very significant decline. And that decline could happen, if you look to the right, that tends to happen in a 3 to 6 months range. And, the preceding rally, the 200-day moving average is a great marker for that. So that's where we are here and now. Based on this data, we have to be alert for a significant reversal in the stock market, in the S&P 500. And again, that doesn't mean it's going to happen. I mean, based on the history here, it could take a couple weeks to happen, a couple days, or it could even be another month or so. But nevertheless, I mean, based on the time factor, once we get into January, we are going to be entering the 13th month of the bear market. So now looking at this, let's just presume that we're following the mega bear market pattern. Now, based on that, I think the best comparisons based on the pattern. And so the red line here that you see in these charts, by the way, the top left, you can see that's 72 to 75. Then the top right, that's 68 to 70. So I think where the current market is based on the structure and the moving averages, it's kind of following those. And then, 2000 to 2002, based on the macro and many other things, that's a viable comparison. And then at the bottom right, that's the present. And so these are all weekly charts. The blue moving average is equivalent to the 200-day. And then the red there, that's the 40-month moving average, one of my favorite moving averages. And so looking at the top two, the vertical blue lines, that shows when the bear market started. And the other blue line is based on the current time scale about where we are, minus a week or so. So the second line I think is I put based on when the S&P tested the 200-day presently, which was a couple weeks ago. So we can see if we're looking at 73 to 74, it's interesting because that, the market was able to hold above the 40 month twice. And then it had a pretty good rally. It even went above the 200 day. If you're looking at, October 73 in the blue arrow where it peaked. So that, that there could have been a lot of false signals, a lot of false bullish signals at that point in time. After that point, the market really, it really fell apart. It declined to the end of 73, and then it had a bearish consolidation for about 3 or 4 months or so. Then it had the nasty accelerated decline. But you could say the accelerated decline really started at the end of 1973. Now, going over to the 68 to 70, we can see the action around the 40 month. It did kind of move below it. It kind of, traded around it, struggled. Then it was able to rally up to the 200 day, and then it peaked. So that, it peaked. It's very similar to where we are now. And then if we look, that decline didn't accelerate downwards right away. It was kind of, staggered for 3, 4, 5 months. Then it really fell apart at the end. So that's another thing to keep in mind. This accelerated decline is actually, you're getting to the last phase of the mega bear market, cyclically. There's 3 phases. You have the initial decline, then you have the rally to the 200 day, and then sometimes you tend to see another rally to the 200 day, and then there's the accelerated decline, which is the end phase. Now at the bottom left, that's interesting because, based on macro, there's quite a few comparisons to where we are now. I think I talked about in another video. You think of what happened in 1998, kind of similar to what happened during COVID. Then you had this huge, just this mania for 2 years, with the .com stocks. Then you saw that in crypto. You saw it in a lot of these tech stocks that are giving back all their gains. So there's a lot of similarities to that period. But if you look at the structure of 2000 to 2002, there are some differences there. It's interesting because you had, even after, if you look at where we are here and now, roughly a year into it, and you're looking at 2000 to 2002, look at what happened in early 2001. That was a big bear market rally. Rallied up and failed at the 200 day. That already happened early in that bear, but that was a big rally. Then you had a pretty big decline. Then you had another big rally that, rallied up to the 200 day, failed at it, tried again, failed. Then you had another big decline. So the accelerated decline in the 2002, that lasted quite a while. And it was interrupted by some decent rallies. So, and then you can look at the bottom right, which we'll talk about here. I want to go back for a second. Okay. Here we are here and now. So the red line, the blue line is the equivalent to the 200 day. The red line, 40 month moving average. And then at the bottom, you have the S&P ratio against gold. So normally I'm showing gold against the S&P, but in this context, it's the S&P against gold. So that declining is good for gold, bad for the market. And so the market is really at a critical juncture here. Really significant resistance around 4,200. I know some Wall Street people are saying this could rally up to 4,400. You never know. But you have the market just barely above 4,000 right now. A lot of resistance at 4,100. Very stiff resistance at 4,200. So we'll see if it's able to go sideways for a little while, or maybe even pop above 4,200. But you have to be really careful, because a move above 4,200, people who only focus on charts, that could be a false signal. That could be a bull trap. Like, You look at the top left, what happened in 1973. I mean, that was a bull trap. Another thing is, the S&P could break above the trend line, connecting the peaks since 2022. I mean, you'll probably see that on Twitter. But if you look at what happened in 2008, you can draw a similar trend line. And that the '07 to 2009 bear market, you can draw a similar trend line. And in the middle of 2008, the S&P broke above it. And that was just a couple months before everything fell apart, and there was worse than accelerated decline. So, if these little small bullish things happen for the S&P here, over the next couple weeks, we can't just assume that it's in a new paradigm and that it's out, everything, the mega bear market template we can completely throw that out the window. But last thing I want to mention, at the bottom there, if you look at the S&P against gold, that ratio, we can't always go by looks, but that ratio does not look that strong in favor of the stock market. And that's one problem. I mean, if you're a bull on the stock market, this move, you've had everything go up together. I mean, you've had the gold market go up with the stock market. If this was really the start of a real recovery in the stock market would be outperforming gold. So that's really important insight to take away here. And so I just sketched in there at the bottom right. I mean, maybe something like that could play out. We have to be on guard for that. Okay, I know this video is getting too long, but last thing here, this is the analog of how the S&P 500 performs around recessions. And so I think there's, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. All right, so 12 recessions going back to 1948. And basically, the stock market performs the worst from about 2 months before to about 3 months into the recession. Now, you could kind of zoom in, and instead of saying that's 5 months, you could say zoom in. It's like a 4-month period. But let's just think about a 4 or 5 month period. So if you think the recession is going to start, let's say, February or even March or April, then the market, or let's just say you think it's going to start in March, based on this analog here, the market is probably really going to start dumping before February or at the beginning of February in that scenario. So, based on everything we're looking at in the mega bear market template, and then you throw this in here, we have to be really careful. I mean, there's all this talk about, the market's already discounted the recession. You could have said the same thing in 2001, and look what happened. There were still some nasty declines in that bear market. It still had a ways to go. So, we'll see. But definitely, I think there's increasing risk in the stock market. I think that the smart money is going to be selling into this strength. And look, precious metals, miners, they've had a really good move. I think the bottom is in, but they could get hit at the beginning. If the S&P is going to turn lower, the miners will probably get hit with it at the very beginning. So this is a much longer video than I wanted, but let me know what you think in the comments. And I'll talk to you guys again in the next video.